There is a rule in investing that the financial establishment does not talk about loudly enough. And when smart investors finally discover it, it completely rewires how they think about deploying capital. It is called the 66% rule. And no, it is not a stock tip. It is not a secret strategy from a hedge fund. It is a data-backed principle that challenges one of the most deeply held beliefs that everyday investors have about playing it safe. Stay with me, because by the end of this video, you will look at how you invest money in an entirely different way. Let me set the scene. Picture this. You suddenly have a large chunk of money sitting in your bank account. Maybe it is an inheritance, a bonus, a property sale, or money you have been saving for years. The question hits you like a freight train. Do you invest it all right now, today, in one shot? Or do you spread it out over several months, investing a little at a time to protect yourself from a potential crash? Your gut almost certainly says, spread it out. That feels responsible. That feels wise. That feels safe. But here is the uncomfortable truth. Your gut is wrong roughly 2/3 of the time. The debate between investing a lump sum all at once versus gradually dripping money into the market over time has been studied extensively. Vanguard, one of the most respected names in the investment world, examined historical market data spanning nearly a century across the United States, the United Kingdom, and Australia. Their findings were not subtle. Lump sum investing outperformed the gradual approach approximately 66% of the time. That is where the name comes from. 2 out of every 3 times in recorded market history, the investor who went all in immediately ended up with more money than the one who played it cautious. Now, before you dismiss that as just a preference thing, understand the mechanism. When you choose to hold cash and trickle money in slowly, your cash is not just sitting there being neutral. It is actively losing ground. There is a concept called cash drag, and it is brutal. While your money waits on the sidelines, it is not participating in market gains. Historically, equity markets trend upward over time. Companies generate revenue, grow profits, and increase in value. By keeping your money in cash, you are betting that the market will fall or stagnate. That bet has historically lost more often than it has won. Think about it this way. If on average half your money is sitting uninvested during a gradual deployment period of 12 months, that money is missing out on potential gains for an entire year. You are not protecting yourself from risk. You are creating a different kind of risk, the risk of missing out on growth. The Vanguard study showed that on average, the lump sum investor ended up with a portfolio value roughly 2–3% higher than the gradual investor in the United States. That might sound small, but compounded over decades, that gap widens into a difference that could represent years of additional retirement security. And the data gets even more striking when you extend the timeline. Research cited by financial publications found that over a 36-month gradual deployment period, lump sum investing beat the drip feed approach approximately 92% of the time. The longer you sit in cash, the worse your odds become. You are not being cautious, you are working against yourself. But here is where this conversation gets genuinely interesting. And this is the part that most finance channels skip. Understanding that lump sum investing wins mathematically is only half the picture. The other half is understanding the human brain. And the human brain is not a spreadsheet. Our psychology is wired to feel the pain of losses approximately twice as intensely as we feel the pleasure of equivalent gains. This is not a character flaw. It is a deeply embedded survival mechanism. When you have a large sum of money and you invest it all at once, and then the market drops 10% the following week, the emotional damage is real and intense. A lot of investors in that scenario panic. They sell. They lock in permanent losses, and that is the absolute worst outcome, turning a temporary paper decline into an actual financial wound that does not heal. Dollar cost averaging, the strategy of spreading investments over time, acts as an emotional buffer. It protects you from the psychological shock of bad timing. Yes, statistically, it costs you returns in the majority of scenarios. But if the alternative is that you panic sell during a downturn, then the cheaper strategy on paper is actually more expensive in practice. The best investment strategy is not the one that produces the highest theoretical return. It is the one you can stick with when things get uncomfortable. If you are serious about building real wealth and not just understanding theory, but actually implementing a structured approach to financial freedom, I want to point you toward the Wealth Accelerator Academy. It is a group coaching system and course designed to help people like you move from financial uncertainty to genuine financial independence with a clear, proven roadmap. Check the link in the description to learn more about it. Now back to the data, because we also need to talk about that remaining 34% of the time when gradual investing actually wins. This is important, and you need to understand it. The scenarios where spreading your investments over time outperforms are almost always tied to markets that drop sharply right after you begin investing. Think about someone who put a large lump sum into technology stocks in early 2000 at the height of the dot-com bubble. The subsequent crash was devastating. Analysis of that specific period showed that someone who gradually invested over the following 2 years would have experienced dramatically smaller losses compared to someone who went all in at the peak. That scenario is what investors call sequence of returns risk. It is not about the long-term average return. It is about what happens in the specific window right after you deploy your capital. If you are unlucky enough to invest everything right before a major correction, the gradual approach becomes a genuine lifesaver. You are buying at progressively lower prices as the market falls, which lowers your average cost per share. The honest summary is this: lump sum investing wins when markets go up, which is most of the time. Gradual investing wins when markets drop immediately after you start, which happens less frequently but is genuinely painful when it does. Neither strategy has a crystal ball advantage. What they have are different risk and reward profiles. So how do you actually make this decision for yourself? There are 3 questions you need to answer honestly. First, how would you emotionally handle watching your portfolio drop significantly in value within the first few weeks after investing? If your answer is that you would stay calm and hold, lump sum is probably right for you. If your honest answer is that you would feel physically ill and seriously consider selling, you need to factor that into your strategy. Second, how long is your investment horizon? The longer you plan to leave this money invested, the less any short-term timing issue matters. Third, do you have the discipline to automate and execute a gradual investment plan without letting your emotions interfere with the schedule? That last question matters enormously. One of the biggest mistakes people make with gradual investing is they set it up, and then they start second-guessing themselves. The market goes up, and they do not want to buy at a higher price. The market drops and they freeze, waiting for the bottom. If you do that, you are not actually using the strategy you intended. You are just procrastinating with extra steps. For gradual investing to work, it must be automated and non-negotiable. Set it, schedule it, and do not touch it. If you decide gradual investing is right for you, keep the window short. Research strongly suggests that a 6 to 12-month deployment period hits the right balance. It gives you enough spread to reduce timing risk, but gets your capital fully invested quickly enough to benefit from long-term compounding. Anything beyond 12 months, and the cash drag starts to overwhelm any protective benefit you were hoping to get. There is also a third path that I find genuinely compelling for people who are torn: a hybrid approach. Take your full investment amount and immediately put 50% into the market today. Then gradually deploy the remaining 50% over the following 6 months. This way you capture immediate upside if the market rises, and you have capital reserves to deploy at cheaper prices if the market falls. It sounds simple because it is, but it short-circuits the paralysis that keeps so many people sitting in cash doing nothing at all. And doing nothing is statistically the worst option of all. Now let us zoom out and connect this to something bigger. The 66% rule is not just about lump sum versus gradual investing. It is a lesson in how data and human psychology pull in opposite directions constantly. Smart investors know that the winning strategy on paper is not always the winning strategy in real life, because real life includes fear, uncertainty, market noise, and the very human temptation to tinker when things feel uncomfortable. If you want to accelerate your journey toward financial freedom and stop making decisions based on fear or guesswork, I highly encourage you to check out the Wealth Accelerator Academy. The link is in the description below. It is a comprehensive group coaching system and course where real strategies are broken down in a practical, actionable way so that you can start building serious wealth regardless of where you are starting from today. Here is the bottom line on everything we covered. Lump sum investing outperforms gradual investing approximately 66% of the time, based on nearly a century of market data across multiple countries. The reason is simple. Markets generally trend upward, and every day your capital sits uninvested is a day it is not compounding. However, the emotionally intelligent investor knows that the mathematically superior strategy only produces superior results if you actually stay invested. If you would panic and bail during a downturn, the gradual approach buys you the stability you need to stay the course. Know yourself. Make a plan. Write it down. Automate it. And under no circumstances let fear keep you sitting on the sidelines indefinitely. The market rewards patience and punishes hesitation. Whatever strategy you choose, the most important move you can make is to start.